Hey, welcome back everyone to the Real Money Pros. I'm Nic Daniels. Today we're going to talk about the 121 exclusion. People who own multiple properties in addition to their primary home could possibly avoid paying long-term capital gains taxes on those properties. Is it going to work in every scenario? No, but I've seen it work in several, so we're going to talk about that today. But before we get into the stuff on the whiteboard, I just have to encourage you, continue to subscribe to the YouTube channel so that you never miss any of this content that we're putting out here for you, and visit our website, therealmoneypros.com. When you click on the Ask the Experts feature, it sends myself and the entire team here at the Real Money Pros your questions about anything financial you want to cover. We're going to answer it for you free of charge. So now, let's talk about the 121 exclusion. What is this? Well, first of all, it's the 121 exclusion. The IRS says, hey, Mr. Homeowner, if you buy a home and live in that home for at least 2 years out of the last 5 years, then you get to claim an exclusion from capital gains taxes. The limit for a married couple is up to $500,000 in gains. If you bought a home for $500,000, lived in it for 2 years, and were able to sell it for $1 million 2 years later, that $500,000 increase in value, you don't have to pay taxes on that. Now, if you sold it for $1,100,000, that $100,000, the portion above the $500,000 in gains, that part's going to be taxable as long-term capital gains. But usually speaking, we find that most homeowners qualify for the full amount to be excluded from taxes. So here's a scenario. I've seen it work before with real people. I'm not making this up, but here's a scenario that could work for someone who has multiple properties to end up getting out of long-term capital gains taxes altogether. Let's take a look. So you've got the Joneses, and they live in Worktown, and they're nearing retirement. They have a short-term rental in Laketown. Sometimes they use it themselves to go fishing on the weekends. That's not a dolphin, it's actually a fish, because dolphins don't live in lakes. Sometimes they use it for themselves, sometimes they rent it out. But it's not where they want to be permanently once they're done working. Also back in Worktown, they have a rental property. They're nearing retirement and they're thinking, hey, we want to start building our dream home for retirement in Laketown. How are we going to start funding that? Here's something that they could do. Let's say they purchased their primary home in Worktown for $500,000. It's now valued at $1 million. Using the 121 exclusion, they could sell their primary home for $1 million and not have to pay any taxes, long-term capital gains taxes, on that $1 million because of the 121 exclusion. The difference between $1 million and $500,000 is $500,000, and that is the top of the limit for that 121 exclusion. They could sell this property using the 121. Now let's just say that they take the proceeds, the money goes over here to fund their dream build, but they move into this property. They move into this rental, and they live in here for 2 years. What do they get to do? Instead of paying long-term capital gains taxes when they sell this property, because they moved into it for 2 years and made this their new primary residence, when they sell, and let's say that the value of this goes up. Let's say that they end up selling this rental property in 2 years for $450,000. That's a difference of $300,000. Had they sold the rental 2 years ago, they're going to pay long-term capital gains. But because they moved into it and lived in it for 2 years, they made it their primary, guess what? They get to use the 121 exclusion all over again. In this scenario, they live here for 2 years, they sell this for $400,000 or $450,000, and guess what? That entire amount comes to them tax-free because of the 121 exclusion. They can take the money from selling that, and again, they can dump the money into their dream build, but they move into this short-term rental, and they live for another 2 years in the short-term rental. This becomes their primary home. They're living across the lake from eventually what's going to be their dream home. But that's great. They get to oversee the final details of construction. They're managing it, whatnot. They're over there every single day. They live in this place now for 2 years. And what happens in 2 years? they use the 121 exclusion all over again. And when they sell this property, they're no longer on the hook for long-term capital gains as long as their gains are under that $500,000 limit. So they sell this in 2 years and they move into their retirement dream home permanently. They take the proceeds from this and dump it into this, and ideally they've built their dream home debt-free, and they excluded themselves from taxes because they made all of these properties their primary residence for at least 2 years. Obviously, it's going to take about 4 years or 5 years for this strategy to happen. You can only use the 121 exclusion one time every 2 years, but it's a way to take multiple properties that have been used as rentals, turning them into your primary residence, and then getting out of having to pay some long-term capital gains taxes on those properties. Is it going to work for everybody? No. Is this an ideal scenario where you already have a rental in your main town and you have a rental in your future retirement town? Sure, I understand that not everyone has that option available to them, but there is a way using the 121 exclusion to turn rental properties into primary residences and then get out of having to pay long-term capital gains on all of those profits. If you got any questions, send them my way. Go to therealmoneypros.com, click on the Ask the Experts feature, and I'll be sure to answer your questions.